Listen, something extraordinary is happening in the silver market right now. And if you're holding physical silver or thinking about it, the next few weeks could define your financial position for years to come. I'm not talking about the usual price fluctuations we see day to day. I'm talking about a fundamental shift in market structure that's been building for months, and it's finally reaching a critical inflection point. Let me paint you a picture of what's actually happening behind the scenes, because the mainstream financial media isn't telling you this story. They're too busy covering the latest tech stock drama or whatever political theater is dominating the headlines. But while everyone's distracted, something massive is unfolding in the precious metals market. Right now, as I'm recording this, silver is trading in a range that technical analysts are calling a coiled spring. We're seeing a convergence of factors that historically only happens once or twice in a generation. The last time we saw this exact setup was in 2010, right before silver went from $18 to $49 in less than a year. Now, I'm not saying we're going to see that exact move again, but the similarities are impossible to ignore. Here's what's different this time, though. Back in 2010, the move was primarily driven by investment demand and speculation. This time, we've got something far more powerful happening. We've got a genuine supply crisis developing, and it's not the kind that gets resolved quickly. Industrial demand for silver has exploded in ways that nobody predicted 5 years ago. Solar panel production alone is consuming silver at a rate that's grown by 340% since 2019. Think about that for a second. Not 34%, 340%. And it's not just solar. Electric vehicles use 2 to 3 times more silver than traditional cars. Every EV requires about 25 to 50 grams of silver just for the electrical systems. With global EV production expected to hit 30 million units by 2030, we're talking about an additional 750 to 1,500 metric tons of silver demand per year, just from this one sector. That's on top of everything else. But here's where it gets really interesting. The mining industry isn't keeping up. In fact, primary silver mine production has been essentially flat for the last 5 years. We're producing roughly the same amount of silver from dedicated silver mines as we were in 2018, around 25,000 metric tons per year. Meanwhile, industrial demand has grown by over 15%. The math doesn't work. It can't work. Something has to give. Now, you might be thinking, well, they'll just mine more silver, right? That's what I thought too, until I started digging into the actual economics of silver mining. Here's the problem. Most silver doesn't come from silver mines. About 70% of silver production is actually a byproduct of mining other metals, primarily zinc, lead, copper, and gold. So when copper prices are low, or when gold miners are cutting production, silver supply gets squeezed as a side effect. The miners aren't making decisions based on silver prices. They're making decisions based on their primary metal. And right now, we're seeing something unprecedented. Major mining companies are actually reducing their exploration budgets. Why? Because the cost of bringing new mines online has skyrocketed. Environmental regulations, labor costs, energy prices, permitting delays. It now takes an average of 10 to 15 years to bring a new mine from discovery to production. Even if companies started massive exploration programs today, we wouldn't see meaningful new supply until the mid-2030s. Let me tell you about a conversation I had with a mining executive last month. This is a guy who's been in the industry for 30 years, worked on projects all over the world. He told me something that stuck with me. He said, "We know where the silver is. That's not the problem. The problem is that at current prices, most of it isn't economical to extract. And by the time prices rise enough to make it economical, the supply deficit will be so severe that prices will overshoot massively before new supply can respond." Think about what that means. The market is setting up for a supply shock that can't be easily fixed. It's not like oil, where you can turn on spare capacity relatively quickly. It's not like agricultural commodities, where you can plant more next season. Silver mining doesn't work that way. The supply response time is measured in years, not months. Now let's talk about what's happening on the demand side, because this is where things get really fascinating. We've got industrial demand growing at 5 to 7% per year. That's the baseline. But we're also seeing something else, something that doesn't show up clearly in the official statistics. We're seeing a massive increase in physical accumulation by individuals and institutions who understand what's coming. Look at the U.S. Mint Silver Eagle sales. In 2023, they sold over 24 million ounces. That's down from the pandemic highs, sure, but it's still well above the historical average. And here's what's interesting. The premiums on physical silver have remained stubbornly high. Even when the paper price of silver dips, you're still paying $4 to $6 over spot for a silver eagle. That tells you something about the real physical market. There's persistent demand that isn't going away. But the retail market is just the tip of the iceberg. What's really moving the needle is what's happening in the institutional space. Central banks, which have been massive gold buyers for the last decade, are starting to look at silver differently. We're not seeing official central bank silver purchases yet, but we are seeing sovereign wealth funds and large institutional investors quietly accumulating physical silver through various vehicles. I came across a fascinating report from a London-based precious metals dealer who works with ultra-high net worth clients. He said that in the last 18 months, he's seen a dramatic shift in the type of orders coming in. It used to be mostly gold. Now he's getting requests for multi-million-dollar silver positions. These aren't speculators. These are family offices and institutional investors who are looking at the supply-demand fundamentals and making long-term allocation decisions. And then there's what's happening in the ETF space. The big silver ETFs like SLV hold over 500 million ounces of physical silver. That's a massive amount of metal that's been taken off the market and locked up in vaults. But here's what most people don't realize. Those ETFs have to actually hold the physical metal. They can't just hold paper claims. So every time there's a surge of investment demand into silver ETFs, that's real physical silver being removed from the available supply. Now, let me connect some dots for you, because this is where the story gets really compelling. We've got industrial demand growing steadily. We've got investment demand that's elevated and persistent. We've got supply that's essentially flat and can't respond quickly. And we've got a price that's still, in inflation-adjusted terms, well below its 1980 high. Silver hit $50 in 1980. Adjusted for inflation, that's about $185 in today's dollars. We're currently trading around $30. Think about that gap. But here's what really keeps me up at night, in a good way if you're a silver holder. We're starting to see signs of stress in the paper silver market. The COMEX, which is the primary exchange for silver futures trading, has been experiencing some unusual dynamics. The amount of silver available for delivery has been declining relative to the open interest in futures contracts. What does that mean in plain English? It means there are more paper claims on silver than there is actual physical silver readily available to deliver. Now, the COMEX has mechanisms to handle this. They can raise margin requirements. They can incentivize delivery. They can do various things to manage the situation. But the fundamental tension is building. We're in a situation where the paper market and the physical market are starting to diverge. And historically, when that happens in commodity markets, the physical market always wins eventually. Always. Let me tell you a story that illustrates this perfectly. Back in the late 1990s, there was a similar situation developing in the palladium market. Palladium is another precious metal used primarily in catalytic converters. For years, the price was suppressed by large short positions on the futures exchanges. Meanwhile, physical demand was growing and supply was tight. The shorts kept rolling their positions forward, confident that they could maintain control of the market. Then, in 2000, something broke. A major Russian supplier, which had been providing significant supply to the market, suddenly stopped delivering. The physical shortage became undeniable. Within months, palladium went from around $300 an ounce to over $1,000. The shorts were absolutely crushed. Some trading firms nearly went bankrupt trying to cover their positions. The people who held physical palladium made fortunes. Now, I'm not saying silver is going to quintuple in a few months. The silver market is much larger and more liquid than palladium was. But the principle is the same. When you have a persistent physical shortage and a large paper short position, eventually something has to give. And when it does, the move can be explosive. Here's another angle that most people aren't considering. We're living through a period of unprecedented monetary expansion. Since 2020, global central banks have created more money than in the entire previous decade combined. That money has to go somewhere. Some of it went into stocks, some into real estate, some into cryptocurrencies. But increasingly, sophisticated investors are looking at hard assets as a hedge against currency debasement. Gold has been the traditional go-to for this, and we've seen gold perform incredibly well, hitting new all-time highs. But silver has a unique characteristic that makes it potentially even more attractive in this environment. It's both a monetary metal and an industrial metal. It has the inflation hedge properties of gold, but it also benefits from the industrial demand growth story. It's like getting two different investment theses in one asset. And here's something that doesn't get talked about enough: the gold to silver ratio. Historically, this ratio has averaged around 50 to 60. That means it takes 50 to 60 ounces of silver to buy 1 ounce of gold. Right now, we're at around 85 to 90. Silver is historically cheap relative to gold. If that ratio reverts to its historical mean and gold stays where it is, silver would need to rise by 40 to 50% just to get back to normal historical relationships. But what if gold continues to rise? What if we see gold at $3,000 or $3,500 in the next year or two, which many analysts are predicting? If the gold to silver ratio normalizes at the same time, you're looking at silver potentially trading at $50 to $60. And if we get any kind of supply squeeze or investment mania on top of that, the upside could be even more dramatic. Now, I want to take a quick moment here because this is important. If you're someone who's been thinking about protecting your retirement savings with precious metals, there's actually a way to do this that most people don't know about. You can hold physical gold and silver inside a retirement account through what's called a gold IRA. I put together a free guide that explains exactly how this works, how to do it without triggering taxes or penalties, and what to watch out for. If you've got $100,000 or more in retirement accounts, and this is something you've been curious about, check the description below. It's worth understanding your options. All right, back to where this market is headed. Let's talk about what could be the catalyst that finally breaks this market open. There are several scenarios, and honestly, any one of them could be the trigger. Scenario 1. A major supply disruption. Silver mining is concentrated in a handful of countries. Mexico, Peru, and China account for over half of global production. Any significant political instability, labor strikes, or regulatory changes in these countries could immediately tighten supply. We saw a preview of this during the pandemic when several major mines had to shut down temporarily. The market got very tight very quickly. Scenario 2. A surge in investment demand. If we see a major financial crisis or a significant escalation in geopolitical tensions, investors could flood into precious metals as a safe haven. Silver, being more affordable than gold on a per-ounce basis, could see disproportionate retail investment demand. We saw this happen in early 2021 during the Reddit-driven silver squeeze attempt. The price jumped from $25 to $30 in a matter of days, and that was just from retail enthusiasm. Imagine if institutional money started flowing in seriously. Scenario 3. A short squeeze on the COMEX. This is the scenario that keeps the big banks up at night. If enough investors start demanding physical delivery of their futures contracts, and if the available inventory can't meet that demand, we could see a classic short squeeze. The shorts would be forced to cover at any price, driving silver dramatically higher in a very short period of time. Scenario 4, and this is the one I think is most likely. A slow-motion squeeze driven by persistent industrial demand growth and declining available inventory. This wouldn't be a dramatic spike. It would be a steady, relentless grind higher, as the market gradually realizes that supply simply cannot keep up with demand. This is actually more sustainable and potentially more profitable for long-term holders, because it doesn't attract the kind of speculative excess that leads to crashes. Now let's talk about what you're probably wondering. What should you actually do with this information? If you're already holding silver, I think the answer is pretty clear. This is not the time to get shaken out. We're at a critical juncture where patience is about to be rewarded. The fundamentals have never been stronger. The setup has never been better. But markets don't move in straight lines, and there will be volatility along the way. If you're not holding silver yet, or if you're thinking about adding to your position, here's how I would think about it. First, understand that silver is volatile. It can move 5% in a day, 20% in a month. If that kind of volatility is going to keep you up at night, then maybe silver isn't for you, or maybe you need to size your position appropriately. This isn't a trade. This is a strategic allocation based on a multi-year thesis. Second, focus on physical silver, not paper silver. I'm talking about coins, bars, things you can hold in your hand or store in a secure vault. The whole point of this thesis is that there's a divergence between paper claims and physical metal. You want to be on the physical side of that equation. Yes, you'll pay premiums. Yes, there are storage considerations. But that's the price of actually owning the real asset. Third, think about this as insurance that you hope appreciates. The best way to hold silver is as part of a diversified portfolio, as a hedge against monetary instability, and as a speculation on the supply-demand imbalance. If silver goes to $50 or $75 or $100, fantastic, but even if it just preserves your purchasing power while other assets struggle, it's done its job. Now, let me address something that I know some of you are thinking. But what about the manipulation? What about the big banks suppressing the price? Look, I'm not going to tell you that markets are perfectly free and fair. There's plenty of evidence that large institutions have influenced precious metals prices over the years. Several major banks have been fined for spoofing and manipulation in the gold and silver markets. But here's the thing. Manipulation can only work for so long when the fundamentals are against you. You can suppress a price temporarily, but you can't repeal the laws of supply and demand. If industrial users need silver and it's not available, they'll pay whatever they have to pay. If investors want physical metal and dealers don't have it, premiums will rise until supply and demand balance. The physical market always wins in the end. And there are signs that the ability to manipulate is weakening. Regulatory scrutiny has increased. The big banks are less willing to take massive short positions that could blow up in their faces. The market is becoming more transparent. And most importantly, the physical shortage is becoming too obvious to hide. Let me share one more story that I think captures where we are right now. I was talking to a coin dealer in Texas a few weeks ago, a guy who's been in the business for 25 years. He told me that his inventory turnover has completely changed in the last year. It used to be that he'd buy silver from customers, and it would sit in his inventory for weeks or months before selling. Now, he says, anything he gets is gone within days, sometimes hours. He's got a waiting list of customers who want to buy whenever he gets new inventory in. And it's not just him. I'm hearing similar stories from dealers all over the country. The physical market is tight. Really tight. Tighter than the paper price would suggest. That disconnect is telling you something important. It's telling you that the people who actually handle physical silver every day, who see the real supply and demand, know something that the futures traders don't. So here we are, at this turning point. You've got a market that's fundamentally undersupplied. You've got industrial demand that's growing and can't be easily substituted away. You've got investment demand that's persistent and could accelerate. You've got a price that's still well below its inflation-adjusted highs, and you've got a paper market that's increasingly disconnected from physical reality. The question isn't whether silver is going higher. The question is how much higher and how fast. And the answer to that depends on which catalyst hits first and how severe it is. But make no mistake, the pressure is building. Every month that goes by with industrial demand exceeding mine supply, the deficit grows. Every ounce that gets locked up in ETFs or private vaults is one less ounce available for industrial users. Every new solar panel, every new EV, every new 5G installation is consuming silver that isn't being replaced. This is your moment as a silver holder because you're positioned ahead of the crowd. You're holding an asset that most investors still don't understand or appreciate. You're holding something that has genuine scarcity in a world where most financial assets can be created with a keystroke. You're holding something that's essential to the technologies that are supposed to define our future. The mainstream financial world is going to wake up to this story eventually. They always do, but they're always late. By the time CNBC is running special segments on the silver shortage, by the time your neighbor is asking you how to buy silver, the easy money will have already been made. The big moves happen before the crowd arrives, not after. So if you're sitting there wondering whether you should hold on or whether you should add to your position, ask yourself this. Has anything changed about the fundamental thesis? Is industrial demand slowing down? No, it's accelerating. Is new supply coming online? No, it's flat to declining. Are the monetary conditions that favor hard assets changing? No, if anything, they're intensifying. The only thing that's changed is the price, and the price is just noise until the market fully recognizes the reality of the situation. Your job as an investor isn't to predict every wiggle in the price. Your job is to identify asymmetric opportunities where the potential upside dramatically outweighs the downside, and then have the patience and conviction to hold through the volatility. Silver right now is one of the most asymmetric opportunities I've seen in years. The downside is limited. Even in a severe recession, silver has industrial demand that provides a floor. The upside is substantial, potentially multiples of the current price if we get any kind of supply squeeze or investment mania, and the probability of a significant move higher is increasing every day as the supply-demand imbalance becomes more acute. This is not financial advice. I'm not telling you what to do with your money, but I am telling you that something significant is happening in the silver market, and if you're already positioned, you're in the right place at the right time. The fundamentals have never been stronger, the setup has never been better, and the catalysts are lining up. The turning point is here. The question is whether you're going to recognize it for what it is and act accordingly, or whether you're going to look back in a year or two and wish you had. The choice is yours, but the opportunity won't last forever. Markets have a way of staying irrational longer than you expect, and then moving faster than you can react. Don't be the person who understands the thesis perfectly, but waits too long to act on it. This is your moment. The silver market is at an inflection point that only comes around once in a generation. Everything is aligning. The fundamentals, the technicals, the sentiment, the catalysts. It's all there. You just have to have the vision to see it and the courage to act on it. And if you're already holding silver, congratulations. You're exactly where you need to be. Now you just need to hold on and let the market come to you.